So how to structure life insurance with Robert Klein. Okay, what will you learn? How much life insurance should you get? And what type of life insurance policy should you buy? So the first question we want to ask ourselves is, what is the purpose of life insurance? And for this video, we're going to be using replacing your income and paying off your mortgage. Beyond this, there are many other reasons for life insurance, but for this video, we're going to be focusing on these two. So first question, how much life insurance should you get? And I think the three main perspectives that I like to use is 10 times income plus debt is one. Income replacement through rental properties is the second. And life insurance being super inexpensive in certain situations would be the third. So here's a scenario. Here's a 10 times income plus debt calculation. So let's assume someone makes $100,000 a year and unfortunately passes away. So now we need to figure out an alternative of where that $100,000 a year is going to come from. So we're going to need a big pool of money to do so. If they had $1 million and they got a 10% rate of return, that would replicate the $100,000 a year in income. Then we would add the debt of, say, $500,000. So this person's insured need is approximately $1.5 million. Now, the only problem I have with this is this 10% rate of return. And the reason I have a problem with that is I come from the insurance and financial services industry for 20 plus years. Most investment products that they provide over the long run will never produce 10% rate of return. So for me personally, like if I'm with talking about my wife specifically, I would not be comfortable to tell her, hey, put this $1 million into this product, get a 10% rate of return, and you'll be able to replicate that income. This would not be the approach that I would take. So what is the approach I would take? Well, it's income replacement through rental properties. And I'm heavily involved on the real estate side, so I know this stuff quite well. So here's me hanging out at the park, getting 4 ice cream cones for the whole family. And all of a sudden, I pass away. So what happens? Well, a check for $3 million goes to my wife and my 2 kids. So the question is, what is she going to do with that $3 million? Well, the first thing we're going to do is pay off the principal residence mortgage of $700,000. And that's going to free up $3,000 per month. Then we're going to start use the rest of the money to go buy more real estate. Now, I have other property outside of this, but I'm not going to go into that specific detail. But let's say right now we want to go acquire another condo. And we buy a condo for $575,000. What's the analysis of that? Well, a $575,000 condo is paid in cash. For a location that I'm at out in Victoria, the rent would be around $2,200 a month. We then have to subtract expenses. So let's say strata fees of $275 a month, pay off property tax of $120 a month, repairs at 5%, which would be $115 a month, vacancy at 5%, which would be another $115 a month, with a net revenue of $1,575 a month for this specific property. So this gives a cash flow of $1,575 a month. But we have $3 million to work with. So we can go buy condo 2 for another $575,000 and the same cash flow, condo 3 and condo 4. So at the end, we'll have $3 million of clear title paid off property, representing around $9,300 a month of freed up cash flow. So to get more specific, it's more like the principal residence is now paid to zero, so there's no mortgage. And on top of that, there's an income flow of $6,300 a month coming in. So a quick question is, how much did this program cost me? Must be pretty expensive because this seems like a pretty good plan. Well, when I first did it at age 35 years old, the $3 million for a cheap 10-year term contract that had a very cheap cost from age 35 to 45, it cost me $107 a month. Very affordable. Then I actually redid it at age 41 for $3 million for a 20-year term, which basically fixed my costs in from age 41 to 61 for $253 a month. So this cost provided me this entire program for my family. So what is the third way of looking at insurance? Well, another way of looking at it is inexpensive insurance. So what do I mean by that? Well, here's a 40-year-old female, $2 million worth of coverage, 10-year term, $54 a month. Well, a 40-year-old female for $3 million worth of coverage, a 10-year term, is $78 a month. So for basically a $24 a month extra, or $24 a month, they get an extra $1 million in coverage. So it's so cheap, why would you not just take it? And this is really something that you would want to analyze relative to your net worth. Maybe your net worth is quite significant. You can actually fund extra money just because how cheap the coverage is. Or let's say your income is quite high relative to your expenses, then you can put more money into the insurance side of it. So that's another way of looking at it. How much life insurance should you get really comes down to really analyzing these three perspectives. And I think the 10 times income plus debt is probably the quickest way to come to a number. And then when you get into the replacement of rental properties, we can analyze that further. And then the third one is obviously sometimes life insurance is just super cheap. Okay, next question. What type of life insurance should you buy? Well, you got three options: term insurance, universal life, and whole life. With term insurance, you generally are buying a 10-year term contract or a 20-year term contract. With universal life and whole life, you're buying a contract that's going to last to age 100. And because of that, it is substantially more expensive. So let's go through an example of myself when I was 35 for $3 million worth of coverage. The 10-year term contract would cost $107 a month. The 20-year term contract would cost $160 a month. With hindsight, I probably should have just picked up the 20-year term at that time, but I did not. Now, universal life is a contract that's going to be from age 35 to 100. That's $1,530 a month. Whole life is also a contract from age 35 to 100, but with cash value or significant cash value inside of it, and that becomes $3,800 a month. Now, I didn't show this here, but there are whole life 20 pay programs where I pay into it for 20 years and I'm done for $3 million worth of coverage. That's $7,500 a month. So in my position as a 35-year-old, married, having kids, the whole show, getting a cheap 10-year term contract for $107 a month took care of the problem right away. As I mentioned here before, I ended up getting the 10-year term, but here's the trick. Here's the trick with term insurance that most of the industry doesn't really explain, and it's this. See, I bought my 10-year term contract with an option to convert to a contract, universal life or whole life, that would last to age 100 without having to prove insurability if I ever became sick. Okay, so what does that mean? It means this. If I ever had a heart attack or had cancer and I'm no longer insurable, I can convert my super cheap 10-year term contract into a contract that would last to age 100, no questions asked. See, I have no problems paying for the most expensive life insurance if I'm no longer healthy nor insurable. I got lots of problems paying for the most expensive life insurance if I'm still healthy. See, overall, for most people and in most scenarios, buying large term contracts with the options to convert is generally the way to go. So let's actually go analyze my scenario and show you all the dynamics between this. So my overall goal was to do 10-year term contracts, for next 2 or 3 decades, and then reanalyze it at that point. So the first decade, when I was 35 years old, I'm going to improve insurability and I'm going to get a 10-year term contract that costs $107 a month. The renewing option here is not applicable because it's a brand new policy. Now, my other alternative was to buy a contract to last to age 100 for $1,530 a month. Okay, so obviously I already mentioned I picked the 10-year term contract for $107 a month, and that was it. So what happens 10 years later at age 45? Well, if I can prove insurability again, and I can prove I'm healthy, I can actually get the next set of cheapest rates. which is $229 a month for age 45 to age 55. So that's good. Now, if I cannot do this, inside of this contract, I can actually renew my current contract for $487 a month. Now, if you notice this is about 100% plus more expensive if I was able to prove insurability, but it's still not bad. So this is $487 a month from age 45 to age 55. Now, if I was in a position, I might want to take a look at the universal life option because I'm no longer insurable, which would then cost $2,700 a month. But when I think about it myself, if I was 45 in this scenario with, at the time I'd have a 7-year-old and a 10-year-old, I would probably just pick the policy for $487 a month and then continue on. Then let's say I now go to age 55. And again, I can prove insurability. Let's say I'm healthy. The next set of rates for age 55 to age 65 for a 10-year term contract would be $668 a month. Now, here I am, 55 years old. I got a 17-year-old kid and a 20-year-old kid. I probably own a bunch more real estate. A lot more debt has been paid down. The need for analyzing it based on income replacement and debt probably changes. And I probably, in that scenario, might not need $3 million. So maybe if I can prove insurability and I'm good with $1.5 million, this cost would drop in half. But let's assume I'm just going to go with the $3 million just for comparisons. So at age 55, if I could not prove insurability and I had to renew it for the next 10 years from age 55 to age 65, then it's $1,600 a month. At the same time, if I was in a financial position, I would then also look at universal life to age 100, where the price would be $4,600 a month. Now you're probably thinking, who pays $4,600 a month for life insurance? Actually, a lot of people do. Because once you hit your 50s and 60s, you start looking at insurance from an estate point of view. And that's where expensive insurance starts to kick in. But for me, I have basically the option to implement any of these components if I need to. And that's pretty much the main trick to this. So overall, I just want to be able to prove insurability and be healthy all the way through this and just pay the cheapest stuff. I will then consider the expensive stuff when I'm no longer insurable. And another comment I'll have on this $4,600 a month payment, I have the choice of going up to $3 million. I don't need to go to $3 million. I might just take $1 million of it or $2 million of it, depending on what my health situation is. And another way of looking at that too is, is my personal income going to be taking care of that? Not really, because if I actually am truly sick, I'd be looking at my asset base, my investments, my real estate to actually start taking money from that to support this type of payment. The value of this life insurance goes through the roof if I'm no longer insurable. If the insurance company had the option of canceling my insurance after I had a heart attack, they would instantly take it. But in this scenario, that option is in favor of myself. So here's what my original strategy was. What is my current strategy? Well, at age 41, I analyzed all of this again, and I thought to myself, I'm in a better financial position. I don't need a 10-year term contract. Why don't I just go get a 20-year term contract from age 41 to 61? And if I can prove insurability, I'm good. Now I got, which I did, and I qualified, and I now pay $252 a month. And from age 41 to 61, my family is totally covered. And then when age 61 kicks in, I have the option to convert this $3 million contract to a contract to last to age 100 if I choose to do so. So there you go. So how much life insurance should you get? And what type of life insurance policy should you buy? The answer is this: large, cheap term contracts with the option to convert to the most expensive policies without having to prove insurability if you ever became sick. And my caveat to that is this: I would get a 20-year term versus a 10-year term if financials allowed it. So what are the next steps? Well, send me an email to robert@robertklein.ca for insurance numbers. What I would need is how much insurance are you thinking about? 10 times income plus debt is a good start. And then send me your date of birth. And then from there, I'll send you what the cheapest rates are for 10-year term contracts and 20-year term contracts. And then step 3, we'll do a Zoom meeting and we'll actually strategize further and figure out exactly what you should be getting. So there's my contact information. And there you go, how to structure your life insurance.